Hello and welcome to another session of the My Solo 401k Financial Daily YouTube Webinar Series. Thank you so much for joining. We're excited to discuss double your retirement, how to max out both day job 401k and solo 401k plans for the same year. So as always, we're on our YouTube channel. If you like and subscribe, you'll get notifications of when we go live. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, back again at 1 p.m. Pacific, 4 p.m. Eastern. That's the afternoon session we're just starting now. So we always appreciate the chance to discuss questions or topics. I see we've got a few already teed up, which is wonderful. But let's get started. So we just want to first go through some housekeeping. So of course, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So let's first knock out some of these questions that folks have that you've been waiting for, and then we'll dive into the topic, which is, again, double your retirement, how to max out both day job 401k and solo 401k plans. So I see our first question here. It looks like it's from an existing customer. This may be something we'll handle right after the webinar. Let me pull up your email here from the registration list. Thanks for coming, though. We appreciate you bringing the question, of course. Sounds like it's more of an account-specific issue, it looks like. So we're making note of it, and we will follow up shortly after the webinar. Let me just grab the email here and grab the questions. So we make note of those. Yeah, we always appreciate the chance to discuss topics or questions. We like to keep it educational, though, as opposed to too account specific, just to make it nice and broad for everybody. So, but we'll definitely follow up with you shortly thereafter. Thanks for bringing the question. We do appreciate it. So our next question here. My accountant is trying to fill the form 3800 for the tax credits, but it seems to be a one-time thing for 2024 only. I signed up for my solo 401k in 2024. We are wondering how to get the future credits for the next 2 years. Well, this sounds like an existing customer as well. So we'll make a note of your situation, but just to make it broader, and we'll follow up with you specifically with a deep dive webinar that we hosted with an IRS enrolled agent that goes through step by step. But it is a multi-year thing. So as long as the plan is maintained with the automatic contribution feature, which you have the option to opt out of the default contribution percentage and still be eligible to claim the credit. But as long as you maintain that plan for those 3 years, the self-employed business is eligible to claim a $500 credit for 3 consecutive years. So it'd be for 2024, for 2025, and then 2026. So you'd continue to claim it, $500 per year for 3 consecutive years. As simple as that. But we'll be sure to send over a deep dive webinar that we hosted, in case you haven't seen that yet. Let me make note of this question here. Take a quick snippet of it. And then if there are more questions or topics, please feel free to chat those over, and we'll go through those after we go through the slides we wanted to share. And if you're finding this video to be helpful, if you like it, that'll be awesome, as it'll help us to get the word out to other self-employed individuals, solo entrepreneurs like you. As you might imagine, there's a growing number of self-employed individuals out there, and this information can be super valuable to them. Help them secure their retirement account. So yeah, let's dive into double your retirement, how to max out both day job 401k and solo 401k plans. And so that we understand it, let's level set in terms of the basic understanding of what a solo 401k is, who's eligible to set up a plan. The answer is that it's for a self-employed individual, an owner-only business with no full-time W-2 employees, of course, other than that individual or a spouse, if any. So it's, it could be for solopreneurs, like a contractor, maybe a solo practicing professional, like a CPA or a realtor or an attorney, with no non-owner, non-spouse, full-time W-2 employees. Now, some of the basic questions are going to be in terms of eligibility. Do I need a separate entity? The answer is no. We have many, many customers who operate as sole proprietors without a formal legal entity, and that's fine as long as they're reporting earned self-employment income. So earned self-employment income is the key. So you do need to have that earned self-employment income. That can be reported, for example, on Schedule C if your business is taxed as a sole proprietorship. Could be a single member LLC taxed as a sole proprietorship. Could be W-2 wages, for example, for a business that is taxed as an S Corp or a C Corp. Or it could be income reported on a K-1 if your business is taxed as a partnership, specifically on line 14 of your K-1. Now, there's no minimum amount of earned self-employment income that you need to report in order to be eligible to set up a plan. Your spouse or business partner can even participate as long as they're also working in the business and reporting their own earned self-employment income. You can have a solo 401k even if you have a W-2 day job, even if you participate in your W-2 employer-sponsored plan, as long as you've got that separate earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. So that's the basics in terms of what is a solo 401k, who's eligible to set it up. So now we want to dig deeper into contributions, right, and the rules, because we're talking about a scenario here today with respect to how you can double your retirement contributions. In other words, how to max out both a day job 401k that you have through your work, as well as your solo 401k plan that you might have for your self-employed business activity. You might have a side hustle, separate business, right? That you work nights and weekends. So we're going to focus today on a business that is taxed as a sole proprietor, right? So that could be just an unincorporated business, somebody who gets a 1099 for the work that they do, right? It could be a medical professional who has a job at a hospital, but then is also working at a clinic nights and weekends, and they get a 1099 for that income. They haven't set up an entity for that activity, right? They're just acting as a sole proprietor. Or maybe they do have an LLC, but it's taxed as a sole proprietorship, right? It's a disregarded entity. It's a single member LLC where that income is reported on Schedule C. So for focusing on that profile, right, we want to now build up to have a basic understanding of the contribution rules, because that'll help us understand how to max out a day job 401k as well as a solo 401k. So in terms of your ability to contribute to a solo 401k, it's going to depend on different factors. One is that self-employment income, and what that means or how you calculate self-employment income will depend on how your business is taxed. And we'll talk about how you calculate it for that sole proprietor or that single member LLC taxed as a sole proprietor. Another factor is going to be your age. Another factor is whether you're participating in a 401k plan, like a day job 401k plan, which that's the baseline assumption here for today's discussion. And then the type of contribution that you want to make, right? Are you looking to maximize pre-tax contributions to reduce your taxable income now for the year for which you're making the contribution? Or are you looking to make Roth or mega backdoor Roth contributions that are not going to reduce your taxable income now, but that will have that potential for tax-free growth, right? Where the gains could potentially be tax-free. So those are different factors. Now let's break down some of those factors, right? Self-employment income for a business that's taxed as a sole proprietorship. Could be a single member LLC, a 1099 independent contractor. So for those types of businesses, they need to run a pre-calculation to determine their self-employment compensation. So that pre-calculation is going to be their net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. Now, they can't consider W-2 wages from their day job. They can't consider investment income. It's got to be based on earned self-employment income. And you got to run that pre-calculation. So our next slide gives us a good visual of that pre-calculation, right? You start out with line 31 of Schedule C, less 1/2 of the self-employment tax. And our solo 401k calculator will run that for you. We're helping customers every day determine what their self-employment compensation is based on the information they provide us. So once you determine your self-employment compensation, now you can start to calculate how much you can contribute, right? Because you can't save more than you earn, right? You can't save more than your earned self-employment income. So that'll dictate how much you can contribute. And then, of course, additional factors that'll dictate how much you can contribute are the contribution limits. Now, there's an overall limit that applies to the plan, and then you got different sub-limits depending on the type of contribution that you want to make. So for 2024, the overall limit is $69,000 or an additional $7,500 if you're age 50 or older. For 2025, that limit increased from $69,000 to $70,000. The catch-up limit stayed the same at $7,500, except now for 2025, per the Secure Act, they've added this new super catch-up contribution limit. So for those age 60 to 63, instead of $7,500, they can make a super catch-up contribution, assuming they have the self-employment income to justify the contribution. They can make a super catch-up contribution amount of $11,250, bringing their potential overall limit to $81,250. Now, that's the overall limit, right? Now we've got to dig into some of the sub-limits. So with a solo 401k plan, it has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because you can contribute to different buckets, right? You're not just limited to the employee bucket, right? At your day job 401k plan, you can only make employee contributions. Now, your employer may make employer contributions on your behalf, but what you can control is your employee contributions to your day job plan. But when you're self-employed, in the words of the IRS, you're both the employee and the employer. So you're able to fill up multiple buckets potentially, right? We'll go through some of these scenarios, but you could potentially make employee as well as employer. And then if you have a plan like ours that allows it, there's even a third bucket that you can contribute to, which is the voluntary after-tax contribution bucket. And that's how individuals are making mega backdoor Roth contributions to a solo 401k. So we want to look at each of the sub-limits, right, for each of those different contribution types. So we'll start with employee contributions, also referred to as salary deferrals. So for 2024, the employee contribution limit is 100% of that self-employment compensation. Remember, that's line 31 of Schedule C, less 1/2 of the self-employment tax, dollar for dollar, up to $23,000 or an additional $7,500 if you're 50 or older. For 2025, that limit increased to $23,500. The $7,500 limit stayed the same. But if you're age 60 to 63, instead of $7,500, you can contribute $11,250 as long as you get that self-employment income to justify it. Because remember, you can't save more than you earn, but you can contribute 100% dollar for dollar up to $34,750 if you're age 60 to 63 for 2025, between the $23,500 standard employee contribution limit plus the $11,250 catch-up. Now, this employee contribution limit applies at the employee level. So you have to reduce it by contributions that you make to a day job 401k plan. And we're going to see how that works with a few scenarios. Because remember, we're here to discuss how to max out both your day job 401k as well as your solo 401k. Now, one exception to that general rule that the employee contribution limit applies at the employee level across all the different plans that the employee makes contributions to is a 457 governmental plan. So you don't need to aggregate or reduce how much you can contribute to a solo 401k by contributions made to a 457 governmental plan. Now, our plan allows not only for pre-tax employee contributions that reduce the taxable income for the year for which the contributions are made, but also allows for Roth contributions, which would be made on an after-tax basis. So it's not going to reduce the taxable income now, but you got that potential for tax-free growth because now it's in a Roth account. If individuals are going to be making Roth employee contributions, they need to be deposited into a separate sub-account. So individuals might have a pre-tax solo 401k account as well as a Roth solo 401k account. Now, our plan, of course, also allows for employer contributions. That's a second type we're going to talk about. So employer contributions are also referred to as profit-sharing contributions. Now, the limit here is a percentage of your self-employment compensation. Remember, we're always starting with that pre-calculation. Line 31 of Schedule C less 1/2 of the self-employment tax. Of that number, individuals can contribute if your business is taxed as a sole proprietorship, 1099 contractor, single member LLC taxed as a sole proprietorship, 20% of that self-employment compensation figure. Now, you still need to keep in mind the overall limit, right? So the sum of employee contributions, employer contributions, and or voluntary after-tax contributions cannot exceed the lesser of your self-employment compensation or the overall limit, right? 69,000 for 2024, 70,000 for 2025. Now, it's noteworthy, right? Unlike the employee contribution limit that applies at the employee level, employer contributions apply at the plan level. So it's not impacted by contributions made to another plan, like a day job plan. And again, we'll go through some scenarios to illustrate this, right? So unlike employee contributions, where you have to aggregate all the contributions made by the employee to any plan, unless it's a 457 governmental plan, the employee's contributions made to the day job plan are not going to reduce their ability to make employer contributions to the solo 401k. Now, one exception to that general rule is the 403b exception. So all contributions made to the 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, could not exceed the overall limit. Now, Secure Act 2.0 does now allow for employer contributions to be made as Roth contributions. Historically, they are always made as pre-tax contributions. But in our experience, based on client feedback, most of our clients are not choosing to make employer contributions as Roth contributions. And that's because even before the Secure Act 2.0 was enacted and allowed for employer contributions to be made as Roth contributions, our plan already allowed for making mega backdoor Roth contributions. And you can more easily hit your contribution goals, in other words, with less self-employment income, by making voluntary after-tax contributions, because that's how you make mega backdoor Roth contributions. And the voluntary after-tax contribution limit is 100% of your self-employment compensation up to the applicable limit. Whereas we just saw employer contributions is going to be a percentage of self-employment compensation. From a deadline perspective, they're equal, right? So the deadline to make both employer and or voluntary after-tax contributions is the same. And then lastly, you have more flexibility when it comes to voluntary after-tax contributions. So what I mean by that is that you can transfer voluntary after-tax funds out of the solo 401k, for example, to a Roth IRA. Whereas if individuals want to transfer employer contributions made to a Roth solo 401k out of the solo 401k to a Roth IRA, they would first have to meet a triggering event. If individuals are going to be making employer contributions as Roth contributions, some of the FAQs would be, okay, do I need to make those contributions to a separate Roth account? The answer is no. Those employer contributions made as Roth contributions can go into the same Roth account that they might also be making employee contributions to. The limit, again, is 20% of the self-employment compensation. And in terms of how to report, that was an open question, right, for almost a year after the Secure Act 2.0 was enacted. Because, again, historically, employer contributions were always made as pre-tax contributions, so they were tax deductible. It was an open question then as far as how to report employer contributions made as Roth contributions, because Roth contributions, of course, are going to be made on an after-tax basis. And the IRS answered that question via IRS Notice 2024-2, where they clarified that employer contributions made as Roth contributions still need to be reported as tax deductible. So it's going to reduce the taxable income on the employer's return, for example, the 1040, in case of a business tax as a sole proprietorship, for the year for which the contributions are made. But then they're reported as taxable to the employee for the year for which the contributions are deposited. So you might have individuals that are making contributions now in 2025 for 2024. So if those are employer contributions made as Roth contributions for 2024, those are going to reduce the taxable incomes. They're going to be reported as tax deductible on a 2024 1040, but then they'll be reported as taxable to the employee for the year of the deposit, i.e. 2025, via 1099-R that would be issued to the employee. So it's going to reduce the income for 2024, but then have a corresponding raise to the income for 2025, because ultimately it does need to be made on an after-tax basis. So now let's finally turn to this third and final bucket, which is the voluntary after-tax bucket. This is how individuals make mega backdoor Roth contributions. So in order to make those mega backdoor Roth contributions, you need to have a plan like ours that allows for voluntary after-tax contributions and then a subsequent transfer either to a Roth solo 401k or a Roth IRA, because it is that two-step process. First to the after-tax bucket, then transfer to either the Roth solo 401k or to a Roth IRA. So the limit in terms of voluntary after-tax contributions is going to be the lesser of self-employment compensation or the overall limit. Stated differently, you can contribute 100% of your self-employment compensation as a voluntary after-tax contribution up to the overall limit, $69,000 for 2024, $70,000 for 2025. Now, you still need to keep in mind that overall limit, right? The total of employee, employer, and or voluntary after-tax contributions cannot exceed the lesser of self-employment compensation or the overall limit. So if you are making other contributions to the solo 401k, that's going to reduce how much you can contribute as a voluntary after-tax contribution. So other things of note, right? Voluntary after-tax contributions, just like Roth contributions, need to be deposited into a separate account. This is how you end up with folks having three accounts, right? A pre-tax, a Roth, and a voluntary after-tax. Additional noteworthy points would be that once you are age 50 or older, you are able to make those catch-up contributions, right? Whether it's the standard catch-up or the super catch-up if you're age 60 to 63, assuming you have the self-employment income to justify it. But those catch-up contributions are not going to be made as voluntary after-tax contributions. It's not going to be deposited into the voluntary after-tax account. Instead, those catch-up contributions need to be made either as pre-tax contributions to the pre-tax account or as Roth contributions to that separate Roth account. And then lastly, just like employer contributions are not impacted by contributions made to another plan like a day job plan, likewise, voluntary after-tax contributions are not impacted by contributions made to another plan like a day job plan. So the fact that one makes employee contributions to their day job 401k plan is not going to reduce how much they can contribute as a voluntary after-tax contribution to the solo 401k. Now, one exception to that general rule, of course, is the 403b exception, which again provides that any contributions made to the 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, cannot exceed the overall limit. Okay, wonderful. So now that we've laid the foundation with understanding those contribution rules, those limits, now let's start to apply what we just went through to different contribution scenarios. And again, we want to focus on doubling those retirement contributions, how to max out both day job 401k, work 401k contributions, as well as solo 401k contributions. So we'll start out with a scenario where we've got a self-employed business, taxed as a sole proprietorship. Could be a single member LLC, taxed as a disregarded entity where the income's reported on Schedule C, maybe a 1099 NEC independent contractor. It's just one person participating in the plan who's under 50 years of age. Let's assume that they max out contributions to their day job plan, right? So they contributed $23,000 for 2024 or $23,500 for 2025. And their goal is to maximize pre-tax contributions to the solo 401k. And then if possible, make additional Roth and or voluntary after-tax contributions to the solo 401k. We're going to assume that they have $100,000 as self-employment compensation. In other words, after they ran that pre-calculation of line 31 of Schedule C less 1/2 of the self-employment tax, the product of that pre-calculation was $100,000. So how much can they contribute? Well, they're not going to be able to make any employee contributions. Why? Because that, as we talked about, right, that employee contribution limit applies at the employee level. And here they already maxed out contributions to their day job plan. So they can't make any more employee contributions to the solo 401k. Now they can make employer and or voluntary after-tax, because the employer and voluntary after-tax contribution limit is not reduced by contributions made to a day job 401k. Now, if it was a 403B, it would be aggregated, but we're assuming these are contributions made to a day job 401k plan. And their goal was first to maximize the pre-tax contributions. So they can still make those employer pre-tax contributions. So what is that contribution limit? It's 20% of their self-employment compensation. So 20% of $100,000 is $20,000. So they're going to deposit $20,000 into their pre-tax solo 401k account. It's going to reduce their taxable income for the year for which they make the contribution. Now, they can still make additional contributions. They can still make additional voluntary after-tax contributions, right? The voluntary after-tax contribution limit is 100% of their self-employment compensation, not to exceed the overall limit, $69,000 for 2024, $70,000 for 2025. So for 2024, they can contribute another $49,000 as a voluntary after-tax contribution. For 2025, they can contribute another $50,000. Now, that's not going to reduce their taxable income, but they are going to be able to subsequently transfer the funds from the voluntary after-tax account over to their Roth solo 401k or Roth IRA, where they're going to have the potential for tax-free growth, right? Subsequent gains could potentially be tax-free if when they withdraw the money, they make it as a qualified Roth distribution. So now let's change that scenario. Now we're going to talk about, again, someone whose business is taxed as a sole proprietorship, as one person under 50 years of age. They max out contributions to their day job 401k plan. But instead of being focused on making pre-tax contributions and then Roth or mega backdoor Roth contributions, here they're only focused on making Roth and or voluntary after-tax contributions. And again, we're going to assume they have $100,000 of self-employment compensation, right? Line 31 of Schedule C, that's 1/2 of the self-employment tax. So how much can they contribute? Well, they're still not going to be able to make any employee contributions, right? Because they maxed out those employee contributions to their day job plan, and the employee contribution limit applies at the employee level across all the plans that the person contributes to. They're not interested in making employer pre-tax contributions, right? Because their goal here is to maximize Roth or voluntary after-tax. So they're going to be able to contribute 100% of their self-employment compensation, dollar for dollar, up to the overall limit, $69,000 for 2024, $70,000 for 2025. Remember, the voluntary after-tax contribution limit is not reduced by contributions made to a day job plan. Then they can move those funds from the voluntary after-tax account either to a Roth solo 401k or Roth IRA. So at the end of the day, right, they've maxed out the contributions to their day job plan. They contributed, for example, $23,000 for 2024 or $23,500 for 2025. And then on top of that, they could do another $70,000 to the solo 401k. So between the two, they've contributed over $90,000 into retirement accounts between their day job 401k and their solo 401k. Okay, so now let's go back to the scenario and we'll change it. And so instead of someone that's under 50, let's assume we've got somebody that's 50 or older. They still have that day job plan. They're still maxing out contributions to their day job plan. And their goal here is to just maximize Roth and or voluntary after-tax contributions. So how does that change how much they can contribute? Well, they're still not going to be able to make any employee contributions because they maxed out to the day job plan. So no more employee contributions can be made to the solo 401k. They're still not interested in making pre-tax contributions to the solo 401k. So how much can they contribute as a voluntary after-tax contribution? Well, it's going to be the same amount, right? Because they can't make those catch-up contributions as voluntary after-tax contributions, and they already made the catch-up to their day job plan, right? So they're still going to be able to make another $69,000, 100% of self-employment compensation. Remember, they got $100,000 of self-employment compensation. So that's $69,000 for 2024, $70,000 for 2025. So between the two plans here, you can see, for example, they're contributing for 2025 over $100,000 between the two plans, right? $31,000 to their day job plan, another $70,000 to the solo 401k. Now, what if there's two participants, right? Let's assume that you have two participants, let's say it's a husband and wife that are both working in the same business, they're both reporting their own earned self-employment income, right? Each person has their own Schedule C, where after they run the pre-calculation, each person has $100,000 of self-employment compensation. Each person's under 50. Each person also has a day job plan. They each max out contributions to their day job plan. And each person, both the husband and the wife, they're only interested in making Roth and or voluntary after-tax contributions. So how much can they contribute to the solo 401k? Well, neither of them is going to be able to make any employee contributions because we assume that each person, right, the husband and wife that are both working in the same self-employed business and also have a day job plan, they've each maxed out their day job contributions. They're not interested in making employer pre-tax contributions. They're only interested in Roth or mega backdoor Roth. So each person is going to be able to contribute 100% of their respective self-employment compensation. And here, each person has $100,000. So it's $69,000 for 2024, $70,000 for 2025. So between the two, each person is contributing over $90,000, right? Between their day job plans and the solo 401k. So as a couple, that's over $180,000 that they're contributing to their retirement accounts for 1 year. So you can see that the impact can be tremendous. What you have, the day job plan, plus you're self-employed and you have the self-employment compensation to justify contributions to the solo 401k. So when is the deadline? This is a great question this time of year. You have more time when you're self-employed, right? This is not like a day job plan where you have to make the contributions by the end of the year, right? There's still plenty of people that are making 2024 contributions here in 2025. And that's because self-employed individuals have more time to make contributions, because a lot of self-employed individuals may not know exactly what their self-employment compensation is until after the end of the year. So it's a common sense rule that you have more time. And that's crystal clear in IRS publication 560, which we have an excerpt of. So focusing on a business tax as a sole proprietorship, and for 2024, if your plan was set up, if your solo 401k plan was set up before the end of last year, you can make all types of contributions for 2024 to the solo 401k, of course, subject to the limits, right? Anytime up until your self-employed business tax return deadline, including any timely filed extension. So your self-employed business tax return deadline or your self-employed business tax return is going to be your 1040 if your business is taxed as a sole proprietorship. So if you filed a timely extension for your 2024 1040 and you signed up with us or set up a solo 401k plan somewhere else and then converted to us here now in 2025, you can make all types of contributions for 2024 until that extended deadline, whether employee, employer, or voluntary after tax. So until October 15th. Now, if you didn't set up a plan until 2025, but you filed an extension for your 2024 1040, you could still make employer and or voluntary after-tax contributions for 2024. So you could still set up a plan here in 2025 if you filed that timely extension for your 2024 1040 and make either employer or voluntary after-tax contributions for 2024 by October 15th. And like we talked about in these scenarios, if you max out contributions to another plan for 2024, if you maxed out contributions to your day job plan for 2024, you wouldn't even be able to make employee contributions for 2024 to the solo 401k. But if you filed that extension for your 2024 1040, you could still set up a plan and make employer or voluntary after-tax contributions for 2024 by October 15th. Then this is just another good slide as it shows how the deadline is tied to the self-employed business tax return deadline, right? So for a business tax as a sole proprietorship, it's going to be the 1040 deadline. And the same thing will apply in 2025, but it's going to continue. All right, great. Well, that takes us to the end of the slides that we wanted to share. We appreciate all the participation. Again, if you found this to be helpful, please like this video. It helps us to get the word out, whether you're on LinkedIn or YouTube or Twitter, X, right? Share with those that you think that might find it useful. But just liking will help us to get the word out to others just like you. who are self-employed and might be looking to catch up on their retirement savings or just reach their retirement savings goals. We also have a community, mysolo401k.net/my community. It's totally free to join. We've got over 30,000 members. There's active forums. It's a great way to just see what other people are asking. You can come and ask your own question. Great way to learn and to share the knowledge. Please also subscribe to our channels, whether it's YouTube or LinkedIn or X, as you'll then get notifications of when we go live. So we go live twice a day. Come and ask questions, hear what other people are asking. We try to bring content like this that hopefully is helpful. As always, we appreciate the chance to discuss these topics. And thank you so much.